Now, why do we keep track of current assets and current liabilities? First of all, current assets are those assets that are going to turn into cash in the next 12 months. Current liabilities are those debts that we owe in the next 12 months, right? Which one do we want to have bigger? Current assets or current liabilities? Duh, yeah. Current assets, right? Would you agree with that? Okay. Now, current assets, then, we want to have them bigger, but how much bigger? Yeah, well, yeah, about as much as possible. Yeah, we want to have it big time. But at some point, can we have them too small too? Sure. And to determine how, there's two different calculations that we talk about very commonly in business and in business management. Two special things that we need to always be considering when we're looking at evaluating the successful business. One of them is called working capital. Working capital is how much excess current assets we have. Okay? Now let me show you what I mean by that. Current assets, if we have 50,000 in current assets and we got 30,000 in current liabilities, that means we have working capital of $20,000, correct? Now let me show you where you get this information from. If you'll turn with me for a minute to page 3.1, chapter 3, page 1. We're going to look at a balance sheet. A balance sheet is the result of taking summary information out of the general ledger in the asset, liability, accrual, and capital sections. Okay? Now notice on the left-hand side of this balance sheet, we have our assets section. About halfway down that list, there is a subtotal showing total current assets. Do you see that? How much do we have in current assets? Okay, I'll just round it to $60,000 just so we keep these calculations very simple. Okay, so it's a little over $60,000, right? Now, to calculate the working capital, we're going to take away the current liabilities. Look over on the right-hand side, find the liability, the subtotal that says total current liabilities, and what do we have there? $23,000. So how much working capital does this business have? $37,000. Okay? Was that pretty simple to calculate? It is. Working capital is very simple to calculate. If that number was, is it possible that number could be a negative number? Is it possible that our current liabilities could be greater than our current assets? Sure. That business is perceived as being insolvent at that time. Now, it doesn't mean that they're destined for bankruptcy. It just means that that could be one of the outcomes of it. Okay? And so there's things that we can do to work on that, and we'll talk about different ways to improve a working capital position. More than just increasing our sales, there are different things to do. But this is a very important calculation, and that money means that they've got $37,000 more in current assets than are already spoken for. Okay? However, is $37,000 enough? What do you think?
Well, it depends on the kind of business.
It does. It depends upon the business. It depends on a lot of factors. Okay? Yeah, I mean, if you look at Ford Motor Company, if they only had $37,000 in working capital, would that be a problem? Yeah, because they spend a lot like that, okay? So you've got to look at the size of the business and a lot of issues in determining if that's enough or not. But there's one simple calculation that we use in identifying if that's sufficient. If we can consider that company on very solid ground or very loose ground. And that's called current ratio. Now, see, the working capital just gives us a number. Current ratio tells us, is it a quality, a good enough number? Okay? And current ratio is calculated using exactly the same numbers, but division instead of subtraction. So we take our current assets, we divide our current liabilities, and that gives us our current ratio. So here we've got current assets of $60,000. We've got our current liabilities of $23,000. Same numbers, but division instead of subtraction. Would somebody calculate that for me? You got your calculators right there in front of you. What's the number? Take 60 and divide it by 23. Don't need all the zeros.
32,000.
What'd you get?
I did it wrong.
Yeah, I think you did right.
Really?
Yeah.
15. Okay.
What'd you get?
2.61.
2.6. Okay? Now, what that has said is that they have a current ratio of 2.6 to 1. They've got $2.60 in current assets for every $1 of current liabilities. Their current assets are 2.6 times their current liabilities. Now, with that number, we can establish a qualitative indicator by looking at what a good ratio is 2 to 1 or better. Okay? Is this better than 2 to 1? Yeah, it is. 2.6 is better than 2 to 1. And so what we're looking at is we're looking at multipliers of this number, of this number to arrive at this. And this says that we've got 2.6 times our current liabilities in the current asset section. Okay? And so that's good. That's considered and perceived to be a strong company. Could a company be 10 to 1? Sure. That just means that current assets are 10 times the current liabilities. And that's great. What if the next month they're 8 to 1? Is that still good? What if the next month they're 5 to 1? Is that still good? It's better 2 to 1, but what's happening? It's going down. Do you want to try to arrest that trend as soon as possible? And the earlier you identify that downward trend, the easier it is to fix. If you wait until it continues, is it likely to get down below 2 to 1 at some point? And if it does get down below 2 to 1 and you realize that one of your choices is to go out and get a 5-year or 10-year loan, you walk into a bank and it's less than 2 to 1, your chances of getting that loan are diminished considerably from what they would have been had you gone in at 5 to 1. So it throws up the red flags. It says when we're watching those trends, we've got something starting here that we don't want to have continue on. The sooner you identify that, the better. That's the reason why we do accounting every month, is because we're looking for those trends before they become considerable problems. If all the company is doing is getting the tax preparer to do their financials and then having somebody sit down at the end of the year to look at it, it takes 3 points to identify a trend, so it's going to take 3 years of data to be able to catch that trend. And by then it might be too late. So we check the information and watch it every month to capture that information, those trends, those indicators, and make them available to us before it becomes too big a problem. Unfortunately, a lot of businesses don't do that, and it's too late before they realize they've got a serious problem.